Hello and welcome back to another large cap portfolio update. My name is Ryan Hogan and this is the final update for 2022. The value of our large cap portfolio is $3.33 million. This is going to be an update for not only this week but kind of a year in review and some forward-looking statements. I'll save most of the forward-looking statements for 2023, the first week of that update. So our performance review for this week, we had weekly negative returns of 2.29% versus the S&P 500 of negative 1.87%, producing a weekly alpha of negative 5.59%. This week, we did not fare too well. This is primarily due to our over allocation in healthcare, which took a hit this week. Our year-to-date returns were not great versus the S&P 500. We underperformed the S&P 500 and lost a little bit more money than the S&P did this year. But again, we still have our money in great companies. And if you look on a cash flow yield basis, we're in a good position for 2023. Going back to our year-to-date returns, negative 20.53% versus the S&P of 18.59% produces a year-to-date negative alpha of 3.78%, which is not great, but again, hopefully we'll make up some of these lost gains in 2023. Our one-year beta is 0.91 versus year-to-date of 0.95. As always, the S&P 500 beta is always 1. One-year Sharpe ratio, which is a measure of how much risk and return you got the market, and your standard deviation was negative 0.81 versus the S&P 500 of 0.64. The inception return is 232.29% versus the S&P of 234.85%. I was a little scared when I saw this that we were starting to slip up and lose ground against the S&P, but this has happened a number of times and we've always reverted to the mean. Right now we are slightly underperforming since 2010, but we're still keeping up with the S&P 500. Moving on to U.S. Treasury yield curve and economic data. Are rate hikes going to stop? I don't know. I don't think anybody knows for sure. But what I do know is the inversion is still present in the 3-month versus the 10-year, and that is making debt markets very, very strange and act very strangely. The investors are buying longer-term duration securities and avoiding short-term securities, so 3-month to 1-year duration. You see this huge spike, which means investors are not buying those securities, which is pushing up the yield. Right? If you look at how bonds are priced and how their yields are calculated, bonds are typically inversely correlated to stocks, but this past year we've seen that everything was correlated together and it was all correlated in the downward direction. Everything was getting discounted across the board. Inflation was at everybody's forefront of all the investor minds, and so was the Fed. So if you look at today's rates versus last month rates, we saw little change, although mid-duration yields fell. So you see some buying. I think investors are starting to see and hope for the end of inflation, and the Fed is seeing that as well. If you look at year over year, it looks really bad. But if you look at the 3-month trend, inflation is getting cut in half. It's dropping like a rock, which is great news for investors. It's great news for the American public. It's great news for the world. So the next Fed meeting is January 31st through February 1st, 2023, which is interesting because the CPI comes out mid-January and the PPI comes out a week after that. And usually, or at least last month in December, we saw that CPI came out the day the Fed was meeting. So there was almost no time to digest that report. It was very, very quick turnaround. They read it very quickly. They made a decision with all the information they could. And this time it's a little different. The American public and investors are going to be able to digest this report. They're going to be able to consult with each other. They're going to be able to make a better decision because they have a bigger lag between the CPI report and the Fed decision. In other news, the risk-free rate fell to 3.8% versus last month at 4%, which is another indicator that investors are starting to discount their inflation fears. They are starting to price in and say, okay, inflation may have run its course. We're feeling more confident. We'll see what the Fed does at the end of January, but for now, we think it's going to be another 50 basis point raise. In other news, investors are also pricing in a slowdown of rate hikes and the eventual cutoff from the Fed. So if you think about the phases of the Fed, the first phase was rate hike, rate hike, rate hike. We were getting 75 basis points across the board. Now I think you're going to see a slowdown. You're going to see maybe 250s, maybe a 25, and that'll be phase 2 with the slowdown, the deceleration of rate hikes. And then in phase 3, you'll see a complete cutoff. And I think that's going to send stocks through the roof. Now, phase 4, if it ever comes while I'm still here at OSIG, will be the Fed eventually lowering rates to spur demand if we go into a deep enough recession. For now, their focus is inflation and not having it be entrenched, because inflation is corrosive to almost everything. Fed is doing the best they can, and their Fed funds target rate is currently 4.25 to 4.5% after the 50 basis point rate hike on December 14th. So you can see a bit of a gap between what it is currently, 3.8, versus what their target is. PPI versus PMI in depth. So what is PPI? PPI is the Producer Price Index. It's really a family of indexes that measures the average change of selling prices received by domestic producers of goods and services, so exporters. And when they go to export their products, they're measuring their costs and then reporting that back to the Bureau of Labor Statistics, or BLS. It's really, just think of it as, inflation at the wholesale level. So when producers of crops, producers of certain metals or chips go to export their products, they're measuring their input costs and they're reporting that. Now, if you look at PPI year over year, it was at 7.4% versus CPI, which is the consumer measure of inflation, at 7.7%. CPI ran a little hot this year, you could say, versus the PPI, it was more. And so consumers are starting to feel the pressure more than producers are, slightly. The index, just for extra information, was reset to 100 in 1982, and you can see the PPI is currently at around 220, 230, and that just shows you that costs for producers have more than doubled since 1982. So if you look at it year over year, inflation has stayed around 2 to 4% for a while. And so I think that you're going to see some mean reversion, especially with the lags and the effects of the rate hikes moving forward. Now, the Purchasing Managers Index. This is one of my favorite indicators. This is also known as the ISM Manufacturing Index and is a monthly indicator of U.S. economic activity based on a survey of purchasing managers at more than 300 manufacturing firms. So the PMI reading is over 50. If it is, it's usually at 50. 50 means there's no change. A PMI reading of over 50 means the sector is growing. So manufacturing is growing. You can see I've provided a list from Investopedia about all the different things that they measure and how that affects kind of the number that is represented with PMI. So under 50 means that there's cuts, stuff is decreasing, you get economic contractions in your manufacturing sector. It's an interesting indicator. Some say it's not relevant anymore because we've moved to a service-based economy than a goods economy. Again, if you look at the past history, the former Fed chairman Alan Greenspan, one of the most popular Fed chairmen of all time, he was quoted as saying, if he was on a desert island and only got one economic indicator to run the Fed, he would use PMI. So I thought that was really interesting. Moving on to portfolio updates. Here's some news on our holdings. I provided a list of all the dividends we've received. In total, for the month of December, it was about $10,043. It brought our cash balance up to $72,127. I'm keeping our cash balance a little bit on the thicker side going into the new year. I will bring it down over the course of January to about 2%, which is our bare minimum. I want to keep cash employed, especially for when the Fed, turns their entire sentiment around. I want to be in a good position to ride the rally up. Moving into our individual holdings, Zoetis, Librela is going to be their blockbuster product for 23 and 24. So their blockbuster product, by definition, produces revenues of over $100 million in its first year, and they think this one's going to knock it out of the park. So this is an actual material catalyst for the stock. I don't believe it's priced in. Zoetis has fallen from its all-time high, the end of 2021, to being down 25 to 30% this year. I think that this is a material catalyst that is not being priced in. I think people are overlooking the importance of animals in consumers' lives and how much of a staple it is. Moving on to Johnson & Johnson, they have a new healthcare business. It's called Kenvue. The spinoff will be completed in November 2023. Kenvue will house multiple brands such as Band-Aids, Tylenol, Listerine, but will also house the baby powder and other talc-based products that were linked to cancer. I don't know if anybody was really paying attention, but Johnson & Johnson a while ago had a huge scandal where some of their talc-based baby powders were linked to cancer. It was a huge black eye for the company. It was not great at all, and a lot of people were hurt. And so this is a way for Johnson & Johnson really to kind of push some of that sentiment onto a different corporate entity and still keep the shareholders whole. So the shareholders will get shares in Kenvue, and they'll still have this business that has these products such as Band-Aids, Tylenol, Listerine, which actually did $14 billion plus in revenue last year. So it's still a stable, growing business, but it has this huge liability burden with these lawsuits that no one knows the real cost of. No one can estimate how far these lawsuits will go. It's very hard to. It's a way for Johnson & Johnson to push the legal liability onto another entity while keeping the two fastest growing segments of their business, pharmaceuticals and medical devices, inside the original corporate entity. So that's going to shake up the healthcare scene for decades to come. And I think that you'll see maybe even some congressional hearings on Kenvue and why they did this. But we are still going to remain a shareholder in Johnson & Johnson, and when they eventually do this split off, we will be in a position, having done more research, to make a decision on if we're going to hold our new shares in Kenvue. Dividends and trades. Fiserv is our newest holding. We had 95 shares to initiate the position. We will eventually scale this position up to 500 shares, or about $50,000. We sold 100 shares of PayPal for $7,038, and we will be buying Ecolab and adding to our Microsoft position per the group voting on pitches. It was a great term. I learned a lot. And as always, thank you for listening, and I'll see you in the next video.